We're now pretty much through earnings season, and unfortunately, you can't win them all. Two of the stocks I own that I really believe in long term were kind of disappointing this quarter. We'll get into them in just a second. Before we do, please take a minute and check the link you see on your screen for a message from my sponsor, The Motley Fool. It's the best way to support this work I'm doing on my YouTube channel, and you get the top 10 stocks to buy right now. So, a couple of my favorite stocks, or favorite companies to follow, I should say, they're not giant positions for me, are Lemonade, the insurance disruptor, ticker symbol is LMND, and Redfin, ticker symbol RDFN. Both were somewhat disappointing this quarter. We'll start with Lemonade, which is down about 23% since it issued its earnings report, and there are reasons for it. For the most part, the headline numbers were good. It's an insurance company, so in-force premium was up 50% year over year, a pretty nice growth rate. The average customer has a 24% higher premium total with the company than they did a year ago. Gross earned premium, that's the total, not just what they earned this quarter. Or I'm sorry, that is what they earned this quarter. In-force premium is the total. Gross earned premium was up 53% year over year. And they're starting to see some of the increases they've applied for get approved. For example, in California, they just got permission to increase their homeowners insurance rates by 30%, which will allow the underwriting to be a little bit better. The company's still losing money, but it was better than expected. It posted a $53 million adjusted EBITDA loss for the quarter. That was much better than the market was looking for. But there are some concerns. Above all, they're not doing a good job of underwriting, period. They can try to spin it however they want with the catastrophic losses kind of catching them by surprise. But this isn't the first time we've seen that. They're just honestly not doing a very good job of preparing for catastrophic losses. So their gross loss ratio for the quarter was 94%. They try to keep that under 75%, so pretty far off. It was 8% worse than it was a year ago. To be fair, those catastrophic losses due to storms and things like that were up 4 times year over year and contributed 21 points of that gross loss ratio. But as an insurer, you need to have a better plan for that. So I'd like to see that change going forward. That was kind of disappointing. And the company said that a prudent move they're doing. They're pumping the brakes on growth. They said growth will be very moderate until they get their loss ratios under control, which is great, but probably not what the market wanted to hear. They still have $942 million of cash. They burned through almost $100 million in the first half of the year. So the cash burn needs to decline over time pretty quickly. We don't want them to run out of money. But fairly disappointing results from Lemonade. For Redfin, we'll get to them now. That stock did even worse after earnings. They're down 28% since their earnings report came out. Revenue was down by 21% year over year, which is to be expected because the real estate market's so slow. And gross margin rose by 450 basis points, so those were good things. A lot of that had to do with Redfin getting rid of its iBuying business since the second quarter of last year. And also on that note, the net loss improved from $78 million in the second quarter of last year to $27 million in the second quarter of this year. It was not profitable on an adjusted EBITDA basis like shareholders were hoping for. A little more on that in a second, but better than a year ago. They're doing a great job of cross-selling mortgages and title services to people who are buying a house through their agents. And the rental business that they acquired out of bankruptcy, now it's just called Rent. But it includes a lot of properties like rent.com, apartmentguide.com, things like that. Their revenue from rentals was up 19% year over year. So good momentum there. And that's a high gross margin business. It's worth pointing out. Just for perspective, Redfin's rental business ran a 77% gross margin in the second quarter. For the mortgage business, for example, the gross margin was about 11%. So if it can keep growing that rental revenue, that could be the path to profitability. A couple concerns. The market was obviously disappointed that their market share dropped. Redfin's market share was down to 0.83%, down from 0.83% in the second quarter of last year to 0.75% in the second quarter. This is not a surprise to me. They laid off a lot of their agents. They have 32% fewer agents than they did a year ago. So fewer agents, you're going to have less of the real estate market, all other things being equal. And I thought this was a good statistic. Transactions per agent were down only 1% year over year, despite a very, very slow real estate market. Monthly active visitors declined from 53 million to 52 million year over year. again, slow real estate market. I think the real estate market's just a lot slower than investors expected or realized it was. Um, they they were expecting an adjusted EBITDA profit in 2023, and here's really why the stock fell. CEO Glenn Kelman said that that is not going to happen. But he did say that they expect to be adjusted EBITDA profitable over the next 12 months. So essentially a 6-month delay from when they said they were going to hit profitability. But still much, much better than 2022. They're making good progress in the right direction. So with both of these, I'm not planning to sell. I want to wait for these theses to play out. Like I said, Lemonade has a lot of cash to, a lot of runway to hit profitability and get underwriting right. So I'm not ready to give up on the stock yet. At the current cash burn rate, they have about 5 years worth of money in the bank. So I'm going to see how it goes for a little while. I'm definitely going to be watching it closely, though. Redfin is definitely progressing in the right direction. If they can actually attain adjusted EBITDA profitability starting in the third quarter, like they say they're going to, then it could be a very good thing, especially when the real estate market turns. If they can achieve profitability in this real estate market, that would be a very impressive statistic. So I'm keeping them for now. I'd love to hear what you think of either of these two companies. Please leave me any comments you have. I'll do my best to get to each of them individually. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.